The year 2008 will forever be etched in our collective memory as the year when the financial world teetered on the brink of collapse. The speed at which Lehman Brothers, a venerable institution with a 158-year legacy, crumbled was astounding. It was a stark contrast to the slow decline typically witnessed in tangible industries like manufacturing. Think of a rusting steel mill, its machinery grinding to a halt after years of neglect. This image encapsulates the demise of many manufacturing giants. The decline is gradual, visible, and often anticipated. Finance, however, operates in a different realm. It deals with the intangible promises, expectations, and perceived value. There are no assembly lines, no tangible products. Instead, it's a complex web of transactions, algorithms, and interconnected risks. When this web unravels, as it did in 2008, the collapse can be swift and devastating. Lehman Brothers' demise was a harsh reminder of the inherent fragility of the financial system and the ripple effects it can have on the global economy. Finance, unlike manufacturing, thrives on risk. It's the lifeblood of the industry, the engine that drives profits. Investors are drawn to the allure of high returns, often overlooking the potential consequences. This inherent risk-taking is amplified by the intangible nature of financial products. It's far easier to grasp the value of a tangible product, like a car or a refrigerator. But financial instruments like derivatives, credit default swaps, and mortgage-backed securities are complex, opaque, and difficult to evaluate even for seasoned professionals. This lack of transparency creates a breeding ground for excessive risk-taking and, in some cases, outright recklessness. When these risks materialize, the consequences can be catastrophic, not just for the institutions involved, but for the entire financial ecosystem. The collapse of Barings Bank in 1995 serves as a stark reminder of the perils of unchecked risk and the human element in financial disasters. Nick Leeson, a rogue trader based in Singapore, single-handedly brought down the 233-year-old institution. Leeson's strategy involved exploiting price discrepancies between different stock exchanges. Initially, his trades generated substantial profits, fueling a culture of complacency and a lack of oversight. Emboldened by his early success, Leeson took on increasingly larger positions, ultimately betting heavily on the direction of the Japanese stock market. When an earthquake struck Kobe, Japan in 1995, the market plummeted, wiping out Leeson's gains and leaving Barings with massive losses. The bank, once a symbol of financial stability, was declared insolvent, a cautionary tale of how unchecked ambition and inadequate risk management can lead to spectacular downfalls. The 2008 financial crisis, while triggered by the collapse of Lehman Brothers, had its roots in the subprime mortgage market. The allure of easy credit and lax lending standards led to a surge in subprime mortgages, loans granted to borrowers with poor credit histories, and a higher risk of default. These risky mortgages were then packaged into complex financial products known as mortgage-backed securities and sold to investors worldwide. As long as housing prices continued to rise, these securities generated attractive returns. However, when the housing bubble burst, defaults on subprime mortgages surged, sending shockwaves through the financial system. The value of mortgage-backed securities plummeted, causing massive losses for banks and investors who held these toxic assets. Lehman Brothers, heavily invested in the subprime market, was one of the first major institutions to succumb to this contagion. The collapse of Lehman Brothers sent shockwaves through the global financial system. Credit markets froze, banks stopped lending to each other, and the world teetered on the brink of a complete economic meltdown. Faced with this unprecedented crisis, governments around the world took unprecedented measures to stabilize the financial system. In the United States, the government implemented a series of emergency measures, including injecting liquidity into the banking system, guaranteeing interbank loans, and launching a massive asset purchase program known as quantitative easing. These interventions, while controversial, were deemed necessary to prevent a complete collapse of the financial system. The government's actions, while successful in averting a complete meltdown, came at a cost. Taxpayers were left to foot the bill for the bailouts, and the long-term consequences of these unprecedented interventions remain a subject of debate. The 2008 financial crisis left an indelible mark on the global economy. While the immediate crisis has passed, its scars remain, a constant reminder of the fragility of the financial system and the interconnectedness of the global economy. The crisis exposed critical weaknesses in financial regulation, risk management practices, and the very structure of the financial system. In the aftermath of the crisis, governments and regulatory bodies implemented a series of reforms aimed at strengthening the financial system and preventing a repeat of the 2008 meltdown. These reforms, while well-intentioned, have been criticized by some as being insufficient to address the root causes of the crisis. Concerns remain about the continued existence of too-big-to-fail institutions, the complexity of financial instruments, and the potential for regulatory arbitrage. The question that haunts economists, policymakers, and investors alike is whether we have learned the lessons of 2008 and if we are truly prepared for the next financial crisis. The global economy is a complex, interconnected system, constantly evolving and susceptible to unforeseen shocks. While the specific triggers for the next crisis may differ from those of 2008, the underlying vulnerabilities remain. Excessive leverage, opaque financial instruments, and interconnected risks continue to pose significant threats to financial stability. The challenge for policymakers and regulators is to strike a delicate balance between fostering innovation and growth while ensuring the resilience of the financial system. Thank you for watching. If you'd like more insights, please subscribe and like the video.